Hey everybody, Donnie Turner here with the Buying Tampa Bay podcast. So if you guys tuned in last week, then you know that we actually just wrapped up our last series, the Nuts and Bolts series on, how to be a property manager. So with this next series, we thought we would go into what we would like to call the Pro series. Now, one of the advantages, right, of being in the business for so long, having so much experience, is having a well-balanced, experienced team. I think there's no individuals in this business. You need your lenders, you need your inspectors, you need all kinds of people to make the business work. And today we're going to be talking about mortgage lending, one of those things that is on top of everyone's mind these days with the fluctuation of rates and Jerome Powell all of a sudden becoming a hawk, it seems, coming out of his cave. And next week we're going to go into home inspections and just further into this series, continue talking to professionals that we work with and every single day, ranging from insurance, title, banking, all kinds of stuff, even going into the trades later on into the future. So I'm very glad to intro the people that we're speaking with today. Of course, we always have our two co-hosts, Peter Murphy.
Hey, what's going on, guys?
And Chase Clark.
Yeah, good morning, everybody.
And today we're joined with our first pro in this pro series. As I mentioned, we're talking about mortgage lending. So we're actually talking to Kyle Edwards from First Horizon Bank.
Good morning. Thanks for having me, guys.
Great to have you.
Yeah, guys. Hey, we're really excited this morning to have Kyle with us. Kyle's been a friend of ours, for a long time now. Met back in college, but most importantly now, as far as the podcast goes today, he's one of our most trusted mortgage lenders that we've done a lot of deals with. We've referred a ton of buyers to him, and we want him to come on today to kind of tell us a little bit about the mortgage industry and kind of what's going on today. What are some of the things that are being impacted in that industry via rates and terms, and how we as investors and also for our end unit buyers can view the mortgage industry, how it can help us, what are some things out there that we need to be aware of. So Kyle's been doing this a long time, and that's why we're bringing him on today, not just because he's one of our good friends. He's one of the best. He's been at this for over 20 years now, I think 21 years in the business. He's done this at multiple banking institutions. He's been both a mortgage banker and a mortgage broker. Been with 8 different banks in this area and done, I don't know at this point, Kyle, probably hundreds of millions of dollars in loans.
Oh, yeah.
And so he's seen it all. And that's why he's one of our trusted partners and one of our members of our team, if you will, here on the mortgage lending side. So glad to have you with us this morning, Kyle. Thanks for coming on the pod.
Absolutely. Appreciate it again. Thank y'all for having me. I'm honored and excited to talk with you guys a little bit about mortgage lending and what's going on with the markets right now. It's obviously extremely volatile, right? A lot of unprecedented things that are happening in the markets right now. I know Donnie had mentioned Jerome Powell getting hawkish, and there's definitely a pivot from earlier in the year until now. So a lot going on, and a lot to take in, and how we can get ourselves better positioned in the future and now for in the future. So excited to talk about that this morning. So I know that one of the questions that you guys had for me was what's my competitive advantage as a lender, right? So I've been a broker, been a lender, I've done both, and I've been doing this for almost 21 years. And a lot of people ask me, hey, what's one of the things that makes you successful in the business? And it's pretty simple. It's just being honest with people, setting the expectations up front, and just calling people back. It's a very simple thing. There's been a black eye on our industry for years in terms of people just having bad experiences, and obtaining a mortgage, purchasing a home. It's one of the biggest financial decisions that you'll ever make, and you definitely want to be aligned with someone who's going to be honest with you, who's going to give you sound advice, and who's going to help you along the way. And it's a very simple thing to do. And I've probably have lost some business through the years in terms of telling people maybe what they what they need to hear, not what they necessarily want to hear, and just educating them, and I think that's important in this big decision that people are making. And again, it's all about trying to trying to help people, educate them, and getting them on the right track. And sometimes it's all about getting them into a mortgage product that's going to be best suited for them, for their future, for their family. So I think that's in terms of a competitive advantage, I think that's one of them, because sometimes people aren't. It's difficult to tell people sometimes what they don't want to hear, right? I've never had a problem with that, as long as I'm being honest with them, right? So that's just one thing I pride myself over on is just being honest with people and just telling them
Kyle,
what's going to be best for them. Yep.
Yeah, explain to
Yep.
me. Sorry to interrupt.
Yeah, you're good. You're good. Go ahead.
Yep. Of our connections, but explain to me what that looks like exactly. Why would you have to tell someone something they don't want to hear, and where would they go to get different information that would help them buy a house? I mean, it seems to me that buying a house is a fairly solid set of facts, and when they're getting a loan in order to qualify for a home, they've got to be within a certain bandwidth, and you couldn't lie to someone, or a broker couldn't lie to someone or deceive someone and help them get a loan, right? They're going to fall within certain qualifying criteria, right? So tell me what that looks like and how you've had to do that.
Sure. So it's all about setting expectations, right? So in our industry, when people call up and they want to get pre-approved, pre-qualified, whatever it is, right? It's it's pretty simple. You pull credit, you try to fit them into the criteria, and unfortunately, what a lot of folks do in my industry, and originators and bankers, and again, I'm painting this with a very broad brushstroke, right? But I still see this today. Is that they're like, oh yeah, you're good, you're golden, you're fine, your credit score's okay. It's not the greatest, but we can get you done. We can get you pre-approved, and they issue a pre-approval letter. But it's a lot of times it's not worth the paper it's written on, right? They don't set the expectations. They don't tell them, well, you're going to need 5% down, or you're going to need 10% down, or whatever it is, and they might have some credit blemishes that the lender doesn't necessarily go over with them and say, well, you might need to pay off a collection, you might need to pay down some credit card debt to improve your credit score. They don't set those expectations up front. So the problem is, in terms of, and I don't like using the word lie to them, but they're not necessarily forthright. So and I just a couple weeks ago, just a case in point, I had a client that called me, husband and wife. They called and said that we were talking to this lender, we were under contract, we're set to close in 3 weeks, and now we're hearing that we need like $13,000 more at closing than we needed before. And I was like, that doesn't make a lot of sense. Why? So once I got into it with them, I found out that the rate was not locked. The rate that they qualified them at was much lower up front than it is today, and they hadn't locked the rate. Now it's going to take $8,000 to buy the rate down to get them qualified at a particular interest rate, so they can get them through underwriting. So right. It's they just didn't explain all that to them. So anyway, our rate was better. We got them locked in, and they're closing in in a week and a half. So those types of things, Peter. It's not about telling them, lying to them, point blank up front. It's just not setting the correct expectations up front. And it's and a lot, like I said, a lot of times it's setting those expectations up front. It's sometimes it's not what they want to hear, right? Maybe they need a little bit more money down, and they have to go to a family member to get a gift or something like that, or maybe they have to dip into a 401k program, their 401k to get a little bit extra cash out, those types of things. So it's all about, as being a good originator, being a good mortgage banker, it's all about setting those expectations and not over promising and under delivering it, trying to do the opposite, right?
I get it. Yeah, we have the same thing in our industry, where we have professionals who don't seem to be able to articulate fully the process and the obligations of the parties in the process. And so folks are constantly being caught unawares of some financial of some cash outlay that they're going to need to have, or some process that's going to be far more complicated than they thought it would be. So it sounds like to me, you do a really good job of articulating the full gamut of the process to your clients so that they're not caught unawares when the real cash outlay or the real impact of their credit on their purchase decision comes to face them within the process. And so it sounds like you do a really good and clear job of that.
Yeah, and I try to, and the thing is because of the experience I have in the industry is I almost try to underwrite the loan up front, right? And we all banks, all lenders have automated underwriting systems that you plug the data into, you run it through the system, you pull credit, and you get an approval, either approval or what they call a refer or a denial. But I try to look at all the gotchas up front, right? All the specific details of the loan application and try to hedge off any potential issues that I might see and setting those expectations up front. And when you do that up front, it makes for a much more, smooth process, a much more pleasurable experience in terms of going through the mortgage financing piece of it. And you create long-term sustainable clients and happy clients, Raven fans. And obviously they'll come back to you year after year. So
one thing
can you explain then oh, sorry, Chase. I was going to ask if you could explain some of those gotchas. For anyone listening to the episode who is a first-time home buyer or maybe buying recently now where they haven't bought in a while, what are some of those gotchas, those pitfalls they've got to watch out for in their underwriting process that maybe weren't there the last time they bought a house or aren't something they could find on a Google search?
Yeah, so good question, Peter. So a lot of that, in terms of the first-time homebuyer programs out there, there are some, right? There's obviously one hot program right now is the Hometown Heroes program. That was one of the programs that was rolled out. Governor DeSantis kind of championed that with the Florida Housing Corporation. It's a Florida state bond program that offers up to $25,000 in down payment assistance, and it's really for there's I think over 40 or maybe 50 different career fields that are eligible for that program. Obviously first responders, military, medical professionals, not necessarily medical professionals, but anywhere in the medical field, teachers that are certified, that type of thing. Some of the gotchas with like that program is there's specifics on like debt to income ratio, right? So, they only go up to a certain debt to income ratio, or for instance, they have to be first time home buyers. For instance, I had a realtor that called me last week and said, "Hey, I got a wife. She's a teacher. I've got the boyfriend who wants to go on the loan with her, and he's he works for families like electrician or whatever, but really only one needs to fit into that career field in terms of being eligible for the Hometown Heroes." So she does. But he was put on the deed of his father's home when his father went to, not necessarily on the deed, but he was on the mortgage to help his dad qualify for a cash out refinance. So that was one question that I got into. I'm like, well, are they first time home buyer? Yeah, he's never purchased a house, but no, you have to be a first time home owner. But in that particular case, he was not on the deed. Therefore, and he hasn't lived in that home as his primary residence. So I had to dig into the guidelines, contact Florida Housing, the director of Florida Housing, to find out, hey, here's a very specific situation where he's on the mortgage. It's showing up on his credit report, but he's not on the deed. So he's not an owner of the home, and he hasn't lived there for the last 3 years, or it hasn't used as a primary residence. Would he still qualify as technically as a first-time home buyer? And the answer to that was yes, because he is not on the deed. So in that instance, those are one of those specifics that maybe originators wouldn't necessarily ask all those particular questions up front. So that's just one case in particular. But some of the other things that could be kind of gotchas, I guess you could say, especially with first-time home buyers, is some of the like reserve requirements and that type of thing. Those aren't necessarily needed, but like 401ks and that type of thing, if they have a loan on a 401k. We've got to take that into consideration, sometimes, but it really all depends. But each program is a little bit different, but it's just all about vetting the client up front, the way they should be vetted. So.
We'll be back after a quick break.
You hear a lot about supply chains these days because if the past couple years have taught us anything, it's that an efficient, well-managed supply chain is absolutely critical to keeping businesses successful and consumers happy. I'm Will Haywood, and I host a podcast called All Business, No Boundaries, where we talk about supply chains, how they work, what happens when they don't, and the innovations that are redefining what's possible in the world of logistics. Listen and subscribe wherever you get your podcasts.
Well, experience plays such a vital role in the mortgage business. There's so much to know. There's so many programs out there. There's so many regulations. There's so many gotchas, as you said, that can pop up in the application process that people wouldn't even think about necessarily. And
Right.
you working for First Horizon Bank, you're a mortgage banker, right? That's what we would call you.
Right.
Versus there's a lot of other lenders out there that are classified as mortgage brokers, right?
Right. Mm-hmm.
What's the difference there, and how much of that difference has to do with the way the bank trains and equips you to stay on top of stuff like this versus someone who might be a broker that's not part of a large institution like that?
Yeah, so good question, Chase. So, I mean, the biggest thing is when you're dealing with a mortgage broker, it's, and I'm going to give an analogy here. It's almost like, are you going to hire someone to shop for a car for you? No, you're not. You're going to go direct to the dealer. You're going to get on, autotrader.com, cars.com. You're going to find the car yourself. Typically, with a mortgage broker, when you contact them, they take your application. They are having to package that loan, and they're having to find a wholesale lender that's going to take that loan. And generally, if the mortgage broker's experience, they're going to know where to go. They're going to have 4 or 5 different wholesale lenders that they'll go to, that they know what their guidelines are and that type of thing. But the mortgage broker is at the mercy of that wholesale lender, right? They'll take in the application, they'll kind of know what the guidelines are, but then they have to submit that loan to the wholesale lender for them to approve it, because they're going to be the ones that are going to be funding the loan. The broker doesn't fund the loan. And I know one thing that brokers always say is, we got a bunch of different lenders that I can go through to find you the best deal, to find you the best interest rate. And, you got to keep in mind that not only does that broker need to get paid, but the lender needs to get paid as well. That's funding that loan. So in reality, when you go through a mortgage broker, you're usually going to pay more for that loan than you would if you went through a bank. Okay. And that's typical. And that's usually the case. In some cases, that's not. Sometimes the mortgage broker might have a cream of the crop type of wholesale lender that's looking for, a 780 credit score, 80% loan to value, debt to income ratio that's really strong, that they might be able to send that loan through and actually get a better rate. But then you still have to pay that mortgage broker. So I would say 9 times out of 10, when you're going through a bank, it's going to be a more cost beneficial loan to the borrower than going through a broker, because of that middleman. That broker is a middleman. Okay, so that's really the difference. And the broker doesn't have as much control over the loan, over the client's loan application, than we do as a bank, and that's one of the things, kind of going back to a competitive advantage. Everything is in-house with us, right? In-house processing, underwriting, all that stuff. I have my own team of underwriters that I work through. I know them all. I kind of know what they're looking for. Each of them have their, different niches in terms of, what they are strong at and what they look for and that type of thing. But like I said, it's all pretty much vanilla guidelines, but it's all about having control and knowing what's going on with that loan application through the process, through that 20, 30-day process. and being able to keep in touch with the borrower and knowing, where that loan is, and if they call, hey, how are we doing, and knowing exactly what's going on and being able to give them that feedback so they feel comfortable in this, this big purchase that they're making.
Well, Kyle, why would someone go with a broker then? I mean, if there seems to be some clear advantages to working with a bank from a cost standpoint and a knowledge and internal underwriting process and all that other stuff, why is someone picking up a phone and calling a mortgage broker?
Well, it's a relationship. I mean, maybe the real estate agent has a relationship with a mortgage broker. Maybe it's a friend of the family or something like that. But I will tell you that the one thing that mortgage brokers have that we don't have, one of their advantages is they do have access to private money, and we don't. We have portfolio lending, we can do portfolio loans and that type of thing. But your bank statement loans, I don't want to go back to the term subprime, but obviously that was a big term back in the mid 2000s. But there's your limited documentation type loans that have come back into the market. They've been back in the market the last couple years or so. But those types of loans we don't have access to. We can't do a limited. Everything is fully documented. Everything is QM loans, qualified mortgages. So brokers do have that ability to get access to those types of loans. Obviously, they're going to be much higher interest rates. They're going to require more money down, that type of thing. So they do have access to, different programs and products that we necessarily won't have access to. So that's really I think the only reason why someone would go with a mortgage broker over a mortgage banker.
So yeah, Kyle, you brought up, as you were talking about that, a couple of key things that are really part of the nuts and bolts of getting qualified for a mortgage that maybe we should address now for the audience. And in terms of getting qualified, you mentioned credit score, you mentioned debt to income ratio, right?
Yep.
So maybe talk a little bit about that. Like, where does credit need to be for someone typically to be able to qualify for a conventional loan or an FHA type loan? And what kind of debt to income ratio do they need, and what's considered in that calculation?
Yeah, good question. So yeah, your normal conventional loans, the minimum credit score is a 620. Okay, that's the minimum. Now, to be quite honest with you, do I see many 620 credit scores getting approved going through the automated system? No, I don't. That's the minimum that Fannie Mae, Freddie Mac requires. Usually, if you've got that low of a credit score, you've got to have a pretty big chunk down. I mean, we're talking at least minimum 20%, sometimes 25, 30%, and have reserves, which 1 month reserve is 1 month of a mortgage payment in your account, in your, in liquid assets after you close. So, if you need, 50,000 at closing, your mortgage payment's $2,500 a month. 1 month reserve is $2,500. Okay, so someone typically that has a 620 credit score, there's a reason why. It's credit blemishes in the past and that type of thing. But so that's the minimum.
Because 800 is best, right? 800 is
credit
the
scores
score.
go up to like 850, right? I mean, the highest credit score I've ever seen is like in the 830s, and that's someone who's pretty old, who's had perfect credit their entire life, right? So. But yeah, 620 is the minimum. I mean, an average credit score, I mean, I would probably say is probably right around 715. That's an average, and that's a pretty good credit score. I mean, to give it like a letter grade, 620 is going to be D. That's like a D. I mean, 640, and there's buckets, right? So. Like 620 to 640, that's going to be like a D plus credit score. 640 to 660 is like a C minus. 660 to 680 is like C plus. 680 and above is going to be in your B range. 700 is going to be B plus. 720 A, and then 740 is A plus. Okay, so just to kind of give it a grade average, but and I think your other question was like debt to income ratio, right? So
yeah, what's all included in the calculation?
Yeah, all included. I mean, it's going to be your proposed mortgage payment, and whatever liabilities are shown on your credit report. So car payments, minimum credit card payments, student loan payments, other installment debt. You take all of those, add those up with the proposed mortgage payment of the home that you're looking to buy. You take all of that, divide that by the borrower's gross income. So that would be, if you got two borrowers on there, take their gross income, and that's where you get the debt to income ratio. And average, Fannie Mae says the maximum debt to income ratio is 43%. We can actually go up to 50% if they've got decent credit, and they're putting 5-10% down. We have that flexibility to go up to 50%, and again, that's with automated underwriting approval as well. So, it's
Kyle. So that means 50% of your check every month is going to pay existing debt. That's what a 50% debt to income ratio means.
That is absolutely correct.
And you can go up that high. Now, does that mean including the mortgage payment you're getting ready to take on? Is that correct? Included in that 50%?
That is correct. Yep.
All right. So the bank is saying you should have at least double the amount of money of all your debt obligations and income every month for your household in order to qualify for a mortgage.
Yeah, that is correct. And that's on the high side, right? And I wouldn't necessarily tell someone, hey, yeah, you're good, you're approved with a 50% debt to income ratio, even though I can't approve them. You might be setting the borrower up for failure, right? So if you do it that way, but in those cases where someone's up to it like a 50% debt to income ratio, and you can actually go higher than that on VA and FHA loans. I mean, we can go. I've been able to qualify folks at 60% on a VA loan and 55% on the FHA. Now, again, you don't want to set the borrower up for failure, but at the same time, in those cases, it's usually where you have like a spouse that has bad credit. They've got good income, but they don't have enough, their credit's not good enough to credit qualify. So they can't really go on the loan. So you've got one borrower that's, really qualifying on their own, but in the back of your mind, and they know as well that, hey, I've got another, 80 grand of, income here that's going to go towards helping to pay this mortgage, right? So in those cases, I feel a little bit better writing those loans than I would on someone who doesn't have, a spouse or someone, that can, that has a little bit of a nest egg there in terms of, other income coming in per month. So.
And so with right now, as of April, Zillow is telling us that here in Tampa Bay, the median home price is around $400,000, just shy of that, like $398 and some change. What do you typically see that a household needs in gross income to be able to afford a $400,000 home right now?
Yeah. So I mean, they pretty much chase. I mean, they got to be making 75 to 80 grand a year, okay, minimum, and really have no debt. I mean, maybe a small car payment, $200 a month, minimum credit card payments, $25, $50 a month. So they've got to be making 75 to 80 grand a month. A year salary to qualify for a $400,000 home. And that's pushing it. They're going to be maxed
that's
out.
Like no student loans, no big car
no student
payment. No,
exactly.
no Mercedes in the driveway.
Exactly.
Lifestyle.
Yeah, if they've got a Mercedes and they've got some student loan debt, I mean, they've got to be making six figures. They really do. Yeah.
And so, what's that person bringing down to make a down payment on their house? What are you seeing commonly these days?
Yeah, so commonly, Peter, I mean, I'm doing a lot of 20% down loans. Mortgages. I've got some that are, putting 10% down, 5% down, but the majority of conventional loans that I've been writing are 20% down.
So the person who's buying a $400,000 home, right, is bringing $80,000 in cash to the table to buy that home.
Yep.
All right.
Yep. And where that money's coming from, it's, either they sold the home last year and they've been living with parents, or, they're cashing out a 401k. It's a combination of maybe getting gift money from family, from their parents, that type of thing. So that it's really a combination of where that money's coming from. And I know some people have, they don't want to put all that money down. They want to, keep some money aside, for some improvements, new flooring, whatever, paint, whatever. So they might, put a little bit less down, but yeah, so that's really where that, where they're getting that down payment from. But yeah, I mean, we can do as little down as a 3% loan, 97% financing, but they do have to be a first-time home buyer to get that high LTV type of loan to qualify for that.
Oh, I've got so that's so for what you just said is they've got to have a full year of household income was what we talked about. That person who needs to buy an average home needed to have that much money in the bank to make their down payment on their home, just at bare minimum. And then, of course, they've got some extra lying around to make some fix up because everyone who's moving into an existing home wants Joanna Gaines it, right? So they want to make it beautiful. Yeah. You can't just go with what's there. So that's interesting. When we talked about some of these minimum standards or minimal standards, and do you have any insight onto default, like someone who is coming with a 3% mortgage or who's coming with a debt to income ratio of 50%, like they're spending half of their money on their debt every month? Do you have any insight onto whether or not those people are able to sustain their mortgage payments? Are they defaulting at a higher rate? Or are we in such a situation where people are putting down such a large amount of money that there's enough equity that we're not entering a big wide-scale default problem right now?
Yeah, I mean, I haven't, in terms of, a crisis or a default crisis or anything, we haven't seen that, right? And the reason for that, Peter, is just the amount of equity they have in the home. And again, I mean, someone today buying, doing a 3% down program, we don't know what kind of equity they're going to have. But I mean, you've got to look at the past, right? So, 1 year, 2 years from now, and I mean, looking at a snapshot, of today, those people that put 3% down, a year ago or 2 years ago, yeah, I mean, they might have 20% of equity in their home, right? So, so they've got equity. So even though they might be having a hard time, making their mortgage payment, they're probably going to make it work because they don't want to lose that equity, right? So in terms of a default rate, in terms of those folks putting a very little down right now, we don't have any data on that right now. We will a year from now, but we're personally not seeing very, very minimum defaults right now, very minimal. So and there's probably reasons for that, but I think the main reason is that we've been in we're last year, we're 30% from last year. Obviously, the market has softened. You guys know that. You've seen that. And I think it's, I don't think prices are declining. I think it's more of, inflated prices are just coming back down to reality, right? So I think that's kind of where we're at. But yeah, in terms of answering your question, do I see a lot of defaults? No, we haven't seen those. We really haven't. So usually the default rate is going to be on your lower credit score borrowers, high LTV. So it's really going to be on your FHA loans more than likely, where you're going to see a higher default rate. But I really, over the last 2 years, as you guys know, I couldn't you can't get an FHA buyer to stick over the last 2 years, right? I mean, there was so much demand, so much competition, is that sellers could cherry pick the offers that they wanted, to consider, so that they weren't even considering FHA buyers at that time. So there really hasn't been many of those that have come to play. But historically speaking, the default rates usually come with your lower credit scores, higher LTVs, but we just haven't seen much of that over the last year or two.
So Kyle, one of the biggest pain points, right, even for me as someone who's owned their home for my home and now I've owned for 10 years, and every year my property taxes are increasing. And I can expect that, I'm kind of protected by the 3% Save Our Homes Act in that regard, but 3% on a decent tax bill, still a couple $100 a year, it's going up. Then I get my notice for renewal for my insurance premium, And
Yeah.
for what I feel like is no good reason. We haven't been hit with any hurricanes in
Yeah.
Tampa in a
Yeah.
long time, but they still want another 30% out of me every year, right?
Oh yeah.
And then you got, if you're in an HOA, fortunately I'm not, but if you're in an HOA, you know that with all this inflation and rising costs, you're probably seeing your HOA payment go up. You know, how does all this factor in, you know, when you look at someone purchasing a new house? I mean, do you guys have to factor in the fact that in year 2, their insurance is going to be 30% higher, their property taxes may reset on them, whereas the current owner may only be paying $1,500 a year. They're going to be paying $4,000 a year when they buy this home and it resets with value. How do you factor that into qualifying someone?
Yeah, good question, Chase. So yeah, I mean that's obviously a big thing right now. I mean, borrowers are facing so many different things. I mean, they're facing higher interest rates, property taxes, skyrocketing because of prices going up on homes, and then the cost of insurance, right? I mean, that is just it's crippling to a certain extent. Hoping it's getting a little bit better, but I'm not seeing it yet. My homeowner's insurance went up 40% from last year to this year. So I'm just like, it's crazy. I haven't had a claim, and it's concrete tile roof. So I mean, you're just questioning, why in the world. But good question. So Chase, to answer your question, what we've been doing, one thing that we've always done in the past is when we qualify borrowers, we typically qualify them on the current property tax bill. But as of I guess you could say last year, what we've been doing, and I think it's really to the benefit of the borrower, is we're qualifying them at forecasted property taxes. So if the property taxes, like you said, currently are $1,500 a year on a $380,000 home because the seller, the owner has owned it for 20 years, those property taxes are going to triple. We are qualifying the borrower at those forecasted property taxes to make sure that they would still qualify when those taxes come into play. And a lot of times what we're doing as well is we're also escrowing those higher property taxes as well if the borrower is escrowing their taxes, so they don't get into an escrow shortage when that property tax bill comes due and we pay that for them and they have a huge shortage. So we've been doing that for the last year. But I will tell you that a lot of mortgage companies out there, a lot of banks, they haven't been doing that. So yeah, that's going to be a big issue come, the end of this year, because, folks who bought homes, beginning of the year, in that scenario, their property tax are going to triple their mortgage payment when it's, to cover that escrow shortage and for the forecasted taxes. That mortgage payment might go up $600 a month. How are they going to afford that if they were at a 50 back-end ratio, right? So
there goes the Mercedes.
Yeah, there goes the Mercedes, right? So the thing is, but they're going to have equity, in a lot of, and you're thinking to yourself probably, was that going to create a foreclosure crisis? And I think we're going to see some foreclosures next year, but I don't think it's going to be anything that's going to be ongoing, or it's going to be considered a crisis or anything. I think folks they're going to find a way to make that mortgage payment. I really do feel that way. They might have to cut certain things, but I think the folks that they're going to have a problem, or maybe folks that lose jobs, obviously in the market that we're in, recession, folks that are getting, might be getting laid off, and we're already seeing it. I mean, there's a lot of layoffs out there right now. So, and they're only going to get worse. So, those folks, hopefully they can find other jobs, but if they're not able to, they still got some equity in their home where they can sell it, and that's where the deals are going to be made, to be quite honest with you. I think first quarter of next year is where you're going to start seeing some of those deals come up, where buyers are going to have opportunities to purchase homes where folks can no longer afford their mortgage payment because property taxes, homeowners insurance, they've got huge escrow shortages, and their payment went up. I think you're going to definitely see some opportunities there next year. But is it going to be is it going to flood the market with a huge surplus of homes. I don't necessarily think so, but I think there will be some.
Yeah, you're far more likely to see some serious impact in consumer spending if what we see is an increase in housing related expenses, but equity. You'll see people cutting back on that Mercedes or on that eating out. And so if there is a first market impact, it's likely to be on the consumer side or on the goods side and not on the foreclosure side the way it was last time. So that's good
Right.
for housing. Talk a little bit more too, Kyle, about rates. Now, you and I, Kyle, I was in the gym the other day and Higher came on my playlist. You know that Creed song from like 1,000
Oh, I
years
love it.
ago?
Oh, yeah. That's one of my favorites.
Well,
Absolutely.
it is your favorite because you and I jumped out of an airplane together about, 20 years ago? And
Yeah, a
before
little
you
bit longer than
came,
that. Yeah.
and you had Higher, I think, playing on your recorded soundtrack. So now the reason I bring all that up is because interest rates are higher right now, right? But not as high as I bet they would be. Kyle, I remember betting you at the start of the year that we would see interest rates in around 6% or so. Now, we don't actually see interest rates of at 6% here in the Tampa Bay market, but we have seen them elsewhere. So I would like to call a victory on this bet. So tell me a couple of things. Why are we not seeing interest rates of 6% yet in Tampa when we're seeing them that high in other parts of the country? And is 6% affordable? Is that an appropriate interest rate? Where are interest rates going? Are they going to come down and soften now that we're in this inflation crazy market with JP, boosting the importance of controlling inflation? So give me wax philosophical, please, on skydiving and interest rates.
All right. So a couple things. Yes, we did make a bet a few months ago about where interest rates would be, and I want to preface this by the end of the year. We're not there yet. We still got 3 months, Peter. So you mentioned rates aren't at 6%, Peter. As of yesterday, they are now at 6%. They are. So, but no, it's not. Hey, we haven't hit the end of the year yet. So, but I will say 3 weeks ago, I locked in a client at 4.875. So that was just 3 weeks ago. Today, and it's 11:30 now, rates are out, but I would predict that rates there are probably at 6.125. So that's a point and a quarter swing from 3 weeks ago. Okay. So it is remarkable. It really is. So, and I'll tell you, is that affordable to buyers? And to answer that question, it's really not to folks that were qualified, that were pre-approved, 6-8 months ago. Beginning of the year, rates were between 3 and 3.25. So now, I mean, we're 3 points above that. I mean, that's $150,000 of purchasing power gone because of the hike in interest rates. Okay. That's huge. So, I mean, when you were looking at, a $300,000 home, or let's just say a $400,000 home, back at the beginning of the year, and you were maxed out there, now you're down to 250. There's nothing out there.
No, you can't buy anything.
You can't buy anything, even townhomes, and then you factor in the HOA dues. So, I will say it's been a rough couple of days, and I know, the information that I have, it's not gonna hit the press for another week or so. But stocks got crushed yesterday. The big thing that came out in why we've seen this this change just over, because rates probably Friday of last week were at 5.75. Now we're at probably 6 and 8. Is the PPI number came out? We were not expecting the PPI, the producer price index, which is basically, it was much hotter than expected. That it's a measure of the average change over time in prices paid by the consumer. That's what that is. So you're factoring in with the CPI, energy costs, food costs, housing costs, that type of thing. That number increased by 0.6 of a point. Okay, much higher than we expected, and honestly, next month it might even be higher. So that's basically saying that we were hoping inflation was getting under control. Right now, it's not. It's not under control. So, the markets are very fickle. because of they're just not sure what the Fed's going to do. Now, the Fed's been very, like I said, very hawkish, about, fighting inflation. Obviously, they have to. Okay. But at the same time, they're also wanting to reduce the balance sheet. So these are unprecedented times. Anytime that you see a negative GDP growth over 2 quarters, that's usually defined as a recession. You've never seen the Fed increasing interest rates into a recession, right? But they are, and they have to because of where inflation is, because of all the stimulus money that's been poured into the economy. And I feel like from now to the end of the year, you've got to keep one thing in mind. When the Fed says they're going to increase interest rates, then normal in layman's terms, the consumer thinks that when the Fed increases interest rates, that means it's long-term interest rates. And that's not the case. When they're increasing the federal funds rate, that's affecting, your prime rates, affecting home equity lines of credit, it's affecting auto loan rates, it's affecting credit card rates, that type of thing. And they're doing that to try to tamp down inflation. They're fighting that, and the Fed wants to create some unemployment to try to take some of the froth out of the system right now. But when they do that, and hoping by the end of the year, I would think October, November, probably maybe into December a little bit, we're going to start seeing inflation come down a little bit because of these rate hikes, because it does take time for these rate hikes to infiltrate the system and for consumers to stop spending. When the Fed does increase short-term interest rates, when inflation starts to come down, that's going to preserve the value of long-term bonds. So when the Fed increases short-term rates, it's actually going to have a negative effect, or I guess you could say positive effect, on long-term rates, and you're going to see long-term rates come down. So I think by the end of the year, Peter, I still think we're going to win that bet. I don't think rates are going to be at 6%. I think they're probably going to be closer to 5.5%. And that's what I told you from the very get-go. I think that's where they're going to be. Now, I could be wrong, because the one thing is the reason I say that is because I don't think that we can afford long-term interest rates to be at 6% or higher. Is that a good interest rate? Yeah. And in the long term, looking, when all of our parents bought homes, the rates were probably at 14, or their first homes, rates were 14, 16%. When I first got in the business in 2002, 2001, rates were in the lower sevens, and when they dropped down in the high sixes, it was a refinance boom, right? So we've been so spoiled for so long with rates so low, is that people just think that, man, 6% is just, that's so high. But in the grand scheme of things, it's not that high of a rate. But I really don't think, with all the debt that we have, and we got 30 trillion in U.S. debt, 16 trillion in household debt, that's 46 trillion reasons why I don't think that rates can stay above 6%. And really what's going to determine that is the 10-year treasury, right? I think that's going to dictate what the Fed can do and how far they can go. And I think that 3.5% on the 10-year treasury is kind of a line in the sand. Now, if we get above 3.5% on the 10-year treasury, look out, because it's going to be bad. And
Kyle, a quick question on that, because the 10-year treasury, I was just looking at this, it actually peaked back in mid-June, and in mid-June it was right at 3.5, and we're not even back to 3.5 yet. We're just shy of 3.5, right? So I don't recall us seeing long-term mortgage interest rates spike in mid-June. I know they went up a little bit and then they came back down. But we've kind of seen this yo-yo, right? Where we've got some ups, we got some downs, and they're just kind of hovering, trying to figure out what's going on.
Absolutely. And you're right. And it's very interesting to point out that when the CPI number came out yesterday, that the 2-year treasury spiked. I mean, it was at a 15-year high. It hit like 3.72%, I think it was yesterday. But the 10-year didn't move that much. I mean, it moved some, but it didn't get up as high as it was back in, I think it was like June 19th, if I'm not mistaken. That was the other point where we got above 6%. So that 3.5%, I think that's a line in the sand, and I think that's going to dictate how much the Fed can do, to be quite honest with you. But I do think, next week, I think the Fed's going to increase short-term lending 0.75%. I mean, there's actually over a 30% chance that they might increase it a full 100 basis points on short-term lending. But again, that's going to benefit the overall long-term bonds, okay? Because it's fighting inflation, and inflation is the arch enemy of the bond market. So I do think, and there was an article that came out a couple weeks ago, maybe 10 days ago. Fannie Mae predicted that rates are going to be at 4.5% next year, and I would have to concur with that as well. I do think that rates will drop down next year. They will, but it's going to be a very, very bumpy ride from here to the end of the year. It really will be in terms of interest rates.
Yeah, it's interesting. It's on the minds of everyone, and not just for those looking to buy a home to live in right now, and with those concerns of affordability, but for investors too. Some of us investors out here, we got portfolio loans, with banks where our interest rates are adjusting every time the prime rate changes, and that's having a big impact on our interest rates. But even still, when we look at what investors can do out there right now, we're talking about a 6% rate for an owner-occ. If I'm an investor looking to buy an investment property somewhere, what kind of rate am I looking at? And what might be the difference in what I've got to do as far as down payment and terms go versus an owner-occupant?
Yeah, I think Peter asked that question earlier too, and I apologize I didn't answer it. But yeah, so with investment purchases, investors, they've got to put at least 20% down. Okay. Usually if they put 25% down, that's going to give them a little bit of a break in the rate and the cost. But for investors, 20% down is going to be the minimum. Yeah, interest rates are tough for investments because the margins, these what they call risk-based pricing adjustments that Fannie Mae and Freddie Mac have come down with, they're so high for investments and second home purchases as well. And I'll tell you, back before April of this year, when you and this is just going to be kind of a side note, but when buyers wanted to buy a second home, they could get the same interest rates they could on a primary purchase. But now those rate adjustments for second home buyers are the same as investment. So there's no break in interest rates. So kind of going back to what the rate would be, I mean, you're looking at least 1.5 to maybe 2 points higher in rate for investors. And in addition to that, Chase, is that, and in some cases it can be maybe just a point, but the problem is that the margins are so tight on the coupon discounts right now, is that in a normal market, we could build in a lot of those adjustments into the interest rate. But now, since the margins are so tight, what investors are having to do, the rate might not be 2%, it might only be 1%, but they're having to pay like 2 points in terms of a discount fee towards their closing costs, to offset those risk-based pricing adjustments. So, if it's a $300,000 loan, 2 points is, 1 point is $3,000, 2 points is $6,000. So they're probably looking at a rate that's going to be, over 6%. Maybe, well, I guess if rates are at 6 1/8 now, 6 1/4, they're probably looking at 7.5% paying 2 points. That's the rate as of today. It's crazy. It's crazy. Yeah. So that's about where it's going to be. So and that's on a 30-year fixed rate, right? So obviously 15 years. 15-year terms are lower interest rates and that type of thing. But ARM programs, that's one hot topic right now, is people getting into adjustable rate mortgages, because if rates are going to be lower next year, why not take an ARM? But the margins on those ARMs, they're not even worth looking at. So unless you're going with like a credit union and you're a first-time home buyer, buying, fit into that little box, you can get a pretty decent interest rate on an ARM program. But in terms of the normal, traditional, streamlined, adjustable rate mortgages, those margins, I mean, you're having to pay a ton of points to get the same rate as you would on a fixed rate. So it's not even worth looking at, to be quite honest with you.
Yeah, that makes it a tough underwriting process for an investor, I guess. I mean, from a cash flow basis, even with rising rents right now.
Yeah.
With rising property taxes, rising insurance, and an interest rate 7.5%, maybe even 8%, with a bunch of extra money down on the acquisition side. Hard to squeeze out really good yields right now on a lot of purchases that are financed. So we definitely see the investor activity slow down because of some of the constraints like this.
Yeah, you're right, and obviously it's happening all over. I mean, with all borrowers. But the thing that I'm trying to articulate to home buyers is, when you're looking to buy a house, you're buying the home. Don't buy the mortgage, right? And in this environment, if you fall in love with a home, if it fits your family, if you can afford it now, purchase it. And then I guess the message of the day is better days are ahead. Rates are gonna get better, and they can always refinance it, right? As long as they've got equity. And I think we're still gonna see, home prices. I mean, obviously they're stable now. You are seeing some decline from your inflated prices. But I still think we're going to be, as you guys know, y'all see it, I think there's a lot of pent-up demand out there. There's still a lot of people that are on the sideline that have cash that want to buy a house, but they're unsure what's happening. They're unsure where inflation's going. They're concerned about their job. They're concerned about, the recession fears. They're concerned about, home prices. But I think once we kind of get through this rough patch, I think we're going to see a lot of that pent-up demand kind of get back into the market, and that's where you're going to have some opportunities for investors as well. Because I think you're going to see a little bit more supply hit the market as well, and we've talked about a couple of those things that could be factored into that. So,
Kyle, what are you seeing then? Like for your own personal experience or an industry experience, you've suggested that affordability has dropped by $150,000 because of the movement of interest rates to 6%. You've seen you having to underwrite for future taxes and not present taxes. So the cost of owning homes have gone way up. Your affordability has gone way down. Have you seen just a crash in demand for new mortgages? Has that gone from like 100 to 0 overnight? Where's that for the industry?
It's slow all over. The mortgage lending has fallen to a 4-year low. Okay, so and we saw that probably back starting in April, probably April and May. But yeah, my production is way down. It's way down. So I'm probably. I'm not going to give any percentages, but yeah, I've got a little bit extra time on my hands. I can tell you that. So, but it's across the board. It's everywhere, right?
It's everyone.
Everyone that I talk to, everyone in colleagues that I've spoken with in the mortgage industry, folks, my team and with my company and my office, everyone's down. Everyone is down, and we're doing whatever we can to fight for each and every loan, right?
And the people who are going ahead with closing on homes right now, are these, to the best of your knowledge, cash buyers? Are they people who are flush and well qualified, and it's just the increased cost is immaterial to them? Is it, who is it exactly who's proceeding with buying homes these days?
Yeah, good question. So I think the majority of buyers that I'm working with and that I'm hearing, you still got some cash out there. You still got a lot of cash transactions happening. And obviously I'm not as privy to those because they don't call me.
They don't call you, right?
So, but at the same time, a lot of buyers that I'm seeing are folks that have to purchase or folks that have to sell. It's folks that are moving in state or moving out of state. And it's folks that, a lot of the first-time home buyers out there, they just, they're in a position where they can't afford to purchase right now, so they're getting roommates. They're still, they're taking the rate increases on rents and that type of thing. So I still think that rents will be very, very strong for the coming years. But at the same time, the buyers that are out there, they are, for the most part, very well qualified. And it's folks that have to purchase or folks that have to sell if they're in a divorce situation or they're moving in state or moving out of state. Those are the primary buyers that I'm seeing right now. First time home buyers, they're just, they're shell shocked, right? If I talked to them last year, if they, even inquired on purchasing a home last year, the landscape it's turned on a dime. It's totally different right now.
Yeah, I think you've got some great advice for Tampa Bay home buyers right now, and that statement you made about buy the house, not the mortgage. If you can afford it, go ahead and buy it, because the reality is right now, if you need to buy something, there's very limited inventory.
Exactly.
Of really good product. I mean, inventory's been on the rise, but if you look at what's out there, there's still a lot of people with that shoot the moon pricing, trying to get, last year's prices for their house, and may not be able to get it now just because of the affordability of rates and things like that. But yeah, buy the house, not the mortgage. I think it's really good, positive outlook for people, and that, hey, things are going to get better. Rates aren't going to 10, they're probably not going to 8. Hopefully we'll, as you said, with Fannie Mae forecasting next year, we'll be back down at 4.5, which is a fantastic rate. I remember when I bought my first home, my first rate was 6 3/8. That was 2001. End of 2001, beginning of 2002. 6 3/8. Thought it was great. Then I ended up refinancing, I think, at like 5 7/8. The next year after. And that was fantastic, loved it. Yeah. And that's where we're at now. But prices have gone up quite a bit. Where prices go, we don't know. I think they are kind of steady right now, which is good. If you're an investor out there, some of us in the back of our minds are thinking, man, I'd love to see another housing crash. Give me some of that. Give me some of that 2008 pricing again, right? 10 cents per dollar. I'd love to have that, right? Especially if you got cash on the sidelines. But for the economy as a whole, and for owner ox out there, we definitely don't want to see anything that's going to devastate the world like it did back then.
And nor do we have to. Nor do we have to. I think we've been around long enough to know that the market finds a way. Things seem unaffordable right now to you. If you're trying to buy a home, things seem like demand has dried up. If you're trying to sell, the market finds a way. The doomsday prognosticators are always wrong in the long term. There might be short-term pain and discomfort, but in the long term, things resolve. Prices adjust, incomes rise, new loan programs emerge, things change so that you're not on the sidelines anymore, right? And that's just my experience in being alive now for 43 years. It's my experience of being in this industry for almost 20, is that there will be evolution of the marketplace that will allow you, if you are determined to be involved, to be involved. And that's just the way that capitalism works. So welcome to America. You're in the right country. There will be change. And Kyle might be your guy to help you achieve it in the years ahead, it sounds like.
Yeah, I appreciate that. And the one thing that you got to keep in mind too is in terms of when I said buy the house, not the rate, is that, investors, and especially folks that are buying a primary home, and especially investors as well, is that when rates do come down next year, when all of this kind of stabilizes, inflation starts to come down, when rates drop back down to the 4.5%, that's when this pent-up demand gets back into the market. Okay. And I think that, even if prices just stabilize and don't do much from now to the end of the year, when this demand gets back into the market, then you're going to see prices start to inch up, because obviously demand's going to increase. And I'm not going to say we're going to be right back where we were, 10 months ago or even, 6 months ago, but at the same time, you're still going to be in a seller's market, come next year. And like I said, folks that, get into a 6% rate today, they can always refinance it next year because they're going to have equity, right? They will, so, and that's, I think that's one thing that I keep reminding myself of is that this too will pass. It's going to get better, right? There's a lot of doom and gloom, like Peter said, out there right now, but we can choose to focus on that, or we can choose to focus on the good things that are happening. And like I said, this is a correction, with the way the markets are going, and hopefully the Fed gets the inflation under control, and then next year we're going to be in a whole lot different position.
Yeah, so for the next 6 months or so, until we hit that sweet spot in February, March of next year, hopefully early Q2. Is what I'd love to see 4.5 come around February, March. That'd be fantastic. After the midterms have settled in and all that, that'd be great. But until then, what do we got to do, right? We got to keep our heads in the game. Whether you're in mortgage lending, whether you're real estate, you're an investor. Keep your head in the game, look for opportunities, because there's always opportunities no matter what kind of market you're in. You'll find something out there, and just be ready for these forecasted scenarios to play out, and try and plan for that. Whether you're looking to buy a house, maybe you're going to put that off for the next 6 months because 4.5 makes the kind of house you want to buy affordable, whereas 6% makes it out of your price range. I don't know. But continue to look for opportunities, because when that time comes, you want to be prepared for it. If you're an investor, you want to know how that's going to impact your portfolio, how it's going to impact your ability to maybe flip houses, or how it's going to impact rents and affordability on that side. And so a lot of stuff to be cognizant of right now, and a lot of market conditions to be aware of, news headlines to follow, lots of different theories out there on how to control inflation. All we see right now is gas prices have ticked down just a little bit. Still got a long way to go, but that right there has been the main driver, in my opinion, of why we see groceries so high. You got to truck these things to the store, but the supply side still has to get fixed, and hopefully we'll see that loosen up as we come to the end of this. What's been a really interesting, fun, and crazy 2022 so far.
Agreed.
It sure has.
Yeah. It's like skydiving, right? So when you jump out of a plane, you got that rush. That was like the beginning of the year, and then come April, that's when you land, and it's all over, right?
In one piece, and we did it, and we're better people because of it, right?
Absolutely.
All the life lessons we'll take from that, right?
Oh, I love it. We got to do it again, Peter.
Hey, man, when my kids are out of the house,
Donnie got to join us next time.
Yeah. I got to start thinking about my soundtrack.
Hey, Creed's going to be on mine, that's for sure.
Maybe some Nickelback, 3 Doors Down.
Let's go all the way back. Donnie doesn't remember any of those. They were before he was born, right?
Yeah,
Donnie?
Donnie's like, man, that's
Chumbawamba
like
would be a good opener.
Well, I appreciate it, guys. Yeah, if anyone, any of your viewers or listeners have any questions, feel free to contact me. You can find me on, just Google Kyle Edwards, First Horizon Bank. All my contact information will be in there. I'll be happy to discuss any questions that you guys might have, or, just kind of educate you, talk to you a little bit. I'm not a high pressure sales guy. I like trying to educate people, and just trying to inform you, and, give you the best advice that you can possibly get. So I'd love to talk to you. So just let me know.
Beautiful. Thank you, Kyle.
Yeah, thanks, man.
Appreciate it, Peter.
Highly recommend that. Take him up on his offer if you got questions. Find him on Google, shoot him an email. And thanks again, Kyle. Appreciate your time today.
Appreciate it, Chase. Thanks, Peter. Thanks, Donnie. Y'all have a good day, man.
Hey, everybody. Donnie Turner again. I really hope that you got a lot of value out of today's episode. I'm sure I did. Just with, the current environment that we're in and everything else, and the slowdown in the market and everything, we know that, interest rates are always top of mind. I find it an incredibly interesting topic, and I hope you do as well. So if you are interested in professional property management and you want to know more about how to invest in the Tampa Bay area, if you're a retired landlord that, just
wants to have a little bit of automation in your business to be able to grow its profitability and to be able to reduce your headache, check out HomeProp. Reach out to us. Chase Clark, Peter Murphy, Donnie Turner, we're always happy to talk. Our website is HomeProp, HomeProp.com. You can always email us. You can email me personally, Donnie at HomeProp.com, or Chase and Peter at their first names at HomeProp.com. And stay tuned to the series. We got a lot more coming.